Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Bloomberg Daybreak Asia podcast. I'm Charlie Pellet. Doug Risner's off this week. It is shaping up to be a risk-on day in the Asia Pacific. Weak jobs data out of the U.S. on Wednesday is helping to lock in expectations of a Fed rate cut this month. Coming up, we get some market perspective from Timothy Moe, Chief APAC Regional Equity Strategist at Goldman Sachs. But we begin in the States, where Treasuries bounce back after a slide that put the 30-year yield close to 5%. All eyes now turn to Friday's U.S. jobs report, one of the last key data points before the Fed's quiet period next week. For more, we heard from Audrey Go, head of Asset Allocation at Standard Chartered Wealth Management Group. She spoke with Bloomberg TV's Paul Allen and Avril on the Asia trade.
Audrey, good to see you. Let's start off by what we're seeing in the long end on bonds and this debate that is underway. Is this bull or bear steepening, and how much further are we going to see on this?
Well, thanks for having me. I think we expect the long end to remain reasonably well anchored. So if you look at the range that we're looking at for the US 30-year Treasury bond yields, we are looking at the range of between, say, 4.8 to around 5.1%. And if we look at the latest jobs opening data that were released overnight as well, we have basically continued to see continued moderation in jobs market, where the number of vacancies which is available has dropped to a 10-month low. And we've also seen the vacancy to unemployment ratio, for example, drop below 1 for the first time since 2021. So what this means is now there are more unemployed workers than there are vacancies. And to us, that's likely to continue to weigh on bond yields over a longer-term basis, notwithstanding that we are seeing some short-term spike at the moment in terms of the long end where the Treasury yield is concerned.
What is all this going to mean for the dollar, Audrey?
So for the dollar-wise, I think we wouldn't be surprised if there were to be some mild strengthening in the dollar in the very short term because of concern over fiscal risk, fiscal pressure among major central banks, not just in the US but globally in the euro area as well. But I think again over a 6 to 12 months horizon, given that the Fed we're expecting them to deliver rate cuts starting in September again, and maybe another 2 to 3 rate cuts for the next 12 months or so, we do expect that to likely to add pressure in terms of the dollar, for dollar to be biased on a weaker trajectory over a 12-month horizon. But again, we're not looking for massive weakening because economic data is still holding up reasonably well. And if you were to look at US economic surprises, those are largely neutral, right? But still in a reasonably positive territory. So no major shift from a dollar perspective, and really our advice to investors is to trade the range in terms of bond yield where it comes to bond investors, and then from a dollar as well, largely range bound as well, maybe with a slight weakening bias.
In spite of the relative dollar weakness we are seeing, the yen can't seem to catch a break. What is your sense of where we go from here?
I think the BOJ needs to strike a very delicate balance because on one hand, if we look at economic data, Japanese inflation is clearly above 2% target, closer to 3%, over 3% actually. Prices are quite sticky, wages are also improving. So they are clearly pressed in terms of the need to normalize the monetary policy. But at the same time, with all the uncertainty with regards to bond yields, especially at the long end, as well as trade tensions with the US as well, I think they need to strike a relatively balancing act in terms of not unrattling the market. So for now, we are expecting them to largely stay pat in the upcoming September policy meeting. But over the next 1 year horizon, we are biased to believe that they will be likely to continue hiking interest rate, maybe delivering one rate hike or maybe even two over the next 12 months horizon.
Audrey, a lot of asset prices are looking fairly elevated at the moment. Where are you adding to positions?
So for US, it remains a core holding for us. But given that the US equity markets have also scaled new high together with global equities, we are biased to believe that the markets are probably due for consolidation as it stands for now. And if there were to be any pullback in equity market, we prefer to add within the Asia ex-Japan region, and also with China as well. And China equities have also been doing quite well, being one of the better performers year to date as well. But if you compare the valuations between China as well as Asia relative to global equities, they still trade at a relative discount, and also buffeted or supported by tailwinds from our buyers from a weaker US dollar and potentially moderate, slightly lower in terms of bond yields or range bound in terms of bond yields. And those are the factors that tend to be quite supportive where Asian markets, China equities are concerned, given a weaker dollar tailwind, which also allows central banks in this part of the world to really think about easing policies to continue to support and cushion the economy as well.
Yeah, let's talk a little bit more about Chinese equities, because we're seeing very strong buying. We're also seeing record borrowing to fuel purchases, and opinion seems to be somewhat divided on how sustainable the rally is. How do you view things?
So we are more constructive on Chinese equities. In fact, policy tailwinds aside, we're also seeing some improvement in corporate earnings. And I think importantly, we have seen some shift in sentiment on ground, where consumers, households are starting to maybe take up their maturing deposits or cash holdings and starting to really deploy them into the equity markets, which is really unseen over the last maybe 3 years or so, given the really poor sentiment around that. So on the back of that, we have actually seen an increase in accounts opening in brokerages in China. We have also started to see some decline in cash deposits within the bank as well. And those are also signs that tells us that some of these liquidity momentum related trade in China can continue. But obviously, I think short term they are a little overbought. So our preference here is really for investors to really look to enter them on pullback. And valuations have also risen to about maybe above average, one standard deviation above their 5-year average as well. So net wait for a pullback before re-entering into the market.
Audrey, what are some of the risks that you think at this point markets are underappreciating?
I think for one will be, key will be maybe another flare-up in trade tension, because I think people are expecting TACO to persist. And I think that in itself is quite unpredictable, because we wouldn't know what might be some of the new policy developments or rhetorics that may be up from the Trump administration. So that's one key risk that I think people may be underappreciating. And second of all is, of course, inflation then. And we've also recently seen a break higher in terms of gold price as well. And clearly from an asset allocation perspective, for our advice to investors is, given these risks, which are still quite abound out there, we would also hold a core allocation to gold, which is one of the key diversifier for portfolios.
Before we let you go, Audrey, I just want to get your thoughts also on some of the assaults that we've seen on Fed independence. We've heard from a number of voices today. The former Treasury Secretary Larry Summers warning of a credibility crisis. Even the governors of the Bank of Thailand and Bank of England weighing in on this as well. But at what point do you see the markets start to worry about this? Where's the timeline and the threshold for the same sort of tantrum that we saw over US trade policy?
I think if we were to see even more Trump nominee into the Federal Reserve Governor Board, I think that might be a key risk for the market to maybe decidedly turn more worrisome on Fed independence. I think for now it is a risk that is lurking in the background, but overall setup of the board is still reasonably, I would say, independent, but of course subject to who the new nominees may be, and also whether Trump may be successful in removing Governor Cook from the council as well. So that's really quite a key development for investors to be watching. But for now, it seems that investors seems to be shrugging that off and seeing that as a background risk more than a key significant risk for asset prices.
All right, Audrey Go, Head of Asset Allocation at Standard Chartered Wealth Management Group. Thanks so much for joining us.
Welcome back to the Daybreak Asia podcast. I'm Charlie Pelletin this week for Doug Krisner. We go next to Hong Kong, where Goldman Sachs' inaugural Asia Leaders Conference is underway. It was there that we heard from Timothy Moe, Goldman's chief APAC Regional Equity Strategist. He shared his market outlook during a sit-down with Bloomberg's Avril.
Okay, let's start with what seems to be on a lot of investors' minds, the curve steepening. How is that likely to affect Asia stocks, you think?
Well, generally, a steeper yield curve is better for stocks. And in particular, what matters is the way that the yield curve steepens. And what we're expecting is a so-called bull steepening, which means that the short end of the curve goes down. So you basically have the curve steepening, but because rates are getting lower at the short end of the curve. we've done some statistical work on this, and what we can see is that when you've got lower short end U.S. rates, which of course we expect with the upcoming Fed meeting, we think the Fed will start cutting again, and we think there'll be 3 cuts this year and then 2 more in each quarter next year, that combined with a softer dollar, which we think will be the result in part rates coming down more than Asian rates, is typically a favorable backdrop for Asian stocks, particularly for markets like Korea, Taiwan, Hong Kong, and the Philippines.
What about Japan, though? We saw how those banks really got hammered yesterday. How bad is the march higher in global DM yields on the long end potentially going to be for their bond books?
Typically, well, I want to break that down into 2 bits. So higher rates in Japan should be good for the banks. In fact, that's one of the reasons why we do like banks. Because obviously when rates are or at the very low levels that they were under yield curve control, then the bank's earnings and margins were very, very compressed. So when you've got rates rising from a low absolute level, and you also have a steepening of the yield curve, that's typically a very, very favorable environment for banks. That's the reason why banks have done well. I think with regard to the steepening of the long end of the curve, then there's some concerns about, are there signals there about Japan's fiscal ability to repay its large amount of borrowing, which is about 400% debt to GDP. And so I think that has taken some of the edge off the banks, which had done well previously. So I think it's a bit of a reason for banks to have some profit taking. But overall, we still are favorable on the Japanese banks.
Do you see this as potentially a risk for markets that are more bank heavy, such as Australia?
Generally, yes. I mean, so we're more cautious on banks. If you look at our sector allocations, we generally are more in favor of, for example, the technology space, which obviously plays into the AI theme and so forth, some of the deeper cyclicals, and also some of the more defensive stocks that have higher yields. That's generally been how we're deployed. In the environment that we're expecting where short-end rates are coming down, that's generally not as favorable for banks. And then if you unpack that, you see that some of the indices that are very bank heavy, like Indonesia, where the banking sector is over 60% of the MSCI Indonesia index, tight liquidity domestically, as well as the rate environment that I just described, is typically not good for their profitability. And so if you've got a constraint on profitability for the banks there, and they're 60% of the index, that generally puts some weight on the index overall. So we're underweight Indonesia, in part as a consequence of that.
Just picking up on your point there, Indonesia also in the past week seems to be reflecting these other risks, a reminder of the risks in the EMs. How do you view that market overall?
Well, as I said, we've been underweight there, and obviously there's been political tension and demonstrations and so forth, which have been weighing on the market. We actually think from a fixed income standpoint, a good deal of that is priced, and if things calm down as they appear to be doing, then there is some opportunity to receive rates, which basically means to take a more constructive view on fixed income. But still, when we stack Indonesia up against the rest of the region, in terms of earnings growth and uncertainty about domestic environment, we think there are better alternatives, particularly in North Asia, where we're overweight China, both A&H, overweight Korea, and overweight Japan. And I would note that those 3 markets have done particularly well this year. The spread between them and some of the poor performing markets, which includes Indonesia, which is now the worst performing market in the region, is over 40 percentage points this year, which is double what the 16-17% return on the MSCI index is year to date.
And you see further room to run on the liquidity-driven rally on the mainland?
Yes, we do.
How much more?
Well, we just raised our CSI 300 target from 4,500 to 4,900, and that's about low to mid-teens upside from here, even after gaining 11% in the last month and 17% year to date. And we've had a lot of questions with investors, particularly around our conference here, our Asian Leader Conference, regarding is the liquidity run, has it gone too far? We have a tool we've developed, which is a retail sentiment barometer, which includes 11 to 15 different indicators, all about how liquidity and retail sentiment is performing onshore. And that suggests that, yes, retail sentiment has elevated, but it's nowhere near the extremes that we saw, for example, 10 years ago in 2015, or even in some of the recent spikes in the market. So we still think that the market's not overextended here and is further to run.
Is it also partly to do with how policy risk in China has been compressed, and perhaps partly to do with how the Chinese leadership, the optics surrounding the stock market? Do you think that is also potentially a driver here?
That's very much part of our an input to our thought process. I mean, for example, when Xi Jinping met in February with all the tech leaders, that clearly signaled a shift in terms of the perhaps more repressive attitude towards private enterprises. We did a big series of reports a month or so ago, basically calling for the sort of rejuvenation of the private-owned sector, which is obviously is dominated in market cap terms by many of the tech companies. We really very much like these. We have a group of stocks we call the Prominent 10, which we very much favor. And that is part of our constructive view, particularly on China H shares, the offshore stocks.
What about the policy risk that's coming out of the U.S.? We've seen in the past week for those Chinese waivers for the chip names in Asia, they're getting revoked. How big of a risk are you seeing?
Well, I mean, this is part of the more fraught geopolitical backdrop that we find ourselves in. And one of the ways that we find to translate that backdrop of elevated tension globally is to favor the defense spending theme. This is a theme that we've liked for well over 2 years. It's now more popular. It's done very, very well. We have two baskets on this. It's a core Asia defense and aerospace basket, as well as the defense supply chain. And those are up 40 to 50% this year. So we very much like this theme, think it's a long-term, 5-year, 10-year structural trend. Short-term, it might be a little bit overextended. But in the longer run, we think that it's a theme to remain engaged in.
So short-term overall in the region, we've also seen Asia ex-Japan, how they've climbed from the April lows. Should we be bracing for some form of a correction? If so, when?
Well, thanks for asking the question, because we just introduced a new tool we call RADAR, which stands for Regional Asia Drawdown Risk Model. And it basically is a probabilistic regression model that assesses whether there might be some risk of a pullback in markets of varying degrees. And the punchline is that after the market, as you just said, the broader regional index has rallied over 30% from the April lows without any meaningful pullback, just, not even 5%, just 2-3% pullback at the max. And various momentum indicators being a bit stretched, and also valuations going from over a standard deviation cheap to a standard deviation rich. We think that the markets are probably overdue some sort of a digestion of those gains. Typically, September is a weak month, the weakest month of the year. So if you put all that together, it says there might be a risk of a bit of an air pocket in markets. But then we think that would allow investors to set up for what's typically a stronger fourth quarter. So our call here is the markets have done very well. They might pull back a little bit here to varying degrees. Korea's already pulled back about 5% or so. And then we think it sets us up for a good run into the end of the year.
Okay, so watch the month of September. How
Indeed.
Should we be hedging?
Well, we had some suggestions. Not all investors can do this, but if you look at volatility, that's gone down, the implied volatility for derivative contracts or derivative instruments. So whether it's in the form of a short-dated put or maybe a put spread, we think that is a sort of tactical way as an overlay for investors who can do that to protect some of the downside risk in their portfolio, stay engaged, and be able to position into what we think will be a better fourth quarter run for the end of the year.
Tim, always a pleasure, always amazing. Great to have your insights.
Thank you so much.
Thank you so much. Tim Moe is Chief APAC Regional Equity Strategist at Goldman Sachs.
Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.